There is a specific kind of dread that sets in when you look at your retirement accounts.
Oh, definitely.
It isn't just about, the market going up or down or wondering if you picked the right stock. It's about that silent partner.
Ah, right. The partner who never contributes a single cent but still demands a third of your profits.
Exactly, Uncle Sam. It just feels like taxes are this one variable in wealth building that is totally out of our control. We just sort of have to sit there and take it.
Yeah, you just watch the slice get taken right off the top.
Right. But today, we're actually going to flip that script. We're looking at a concept I've honestly started calling financial alchemy.
Alchemy. Wow. That's a pretty bold word for the tax code. Usually tax code and magic do not belong in the same sentence.
I know, but it fits.
Hmm.
It's about taking this really heavy, tangible asset gold and mixing it with the dry, dusty regulations of the IRS. And what you get is something that actually preserves wealth in a way that, well, neither can really do on their own.
It is a really fascinating intersection because usually people have these two very separate mental buckets.
Right.
Bucket A is gold. That's for doomsday prep, burying it in the yard, apocalypse insurance.
Exactly. The pirate treasure bucket.
Yeah. And then bucket B is your IRAs. And that's stocks, mutual funds, endless boring paperwork.
And never the twain shall meet.
Right. But when you force them to meet, when you create a gold IRA, you enter this space with very specific rules. And if you know how to play by those rules, you unlock some really unique advantages that most investors just completely miss.
So that is our mission for this deep dive. We are exploring the world of gold IRAs. Now, to be clear, we aren't here to tell you to buy gold or sell gold or, build a golden shrine in your living room.
Probably don't do that last one.
Yeah, maybe skip that. We're just here to understand the rules of the game. How does the IRS treat gold when it's wrapped up in a retirement account? And to guide us, we've been combing through some really incredible research from the Gold IRA Company's Bulletin.
Specifically, we're looking at a deep dive on tax advantages authored by Doug Young. And just for some context here, this isn't just a blogger with a hunch.
No, not at all.
Doug is a former financial director. He has over 20 years of market experience, and he's spent the last 15 years specifically focused on the gold IRA niche.
So he has seen the good, the bad, and the really ugly IRS audits.
Oh, absolutely. He's evaluated over 80 gold IRA companies since 2011 alone. So the insights we're unpacking today, they come from a place of deep institutional knowledge, not just, glossy sales brochures.
Okay, so let's lay out the roadmap for everyone. We've got 3 big pillars to cover today. First, the immediate gratification, how this vehicle can actually lower your tax bill right now, today.
Always nice.
Very nice. Second, the long game. That's the tax-deferred growth engine.
Oh.
And third, the part everyone kind of forgets until it's a total disaster, the exit strategy.
And man, that exit strategy is critical because the IRS has a plan for your money even if you don't. If you don't know how to get the gold out of the IRA properly, you can lose a massive chunk of your gains to penalties.
Yikes. Okay, well, let's start at the very beginning then. For the listener who hears Gold IRA and just immediately pictures a vault in a heist movie, what exactly are we talking about here?
Well, a gold IRA is, at its absolute core, a self-directed individual retirement account. But instead of holding paper assets, shares of Apple, government bonds, mutual funds, it holds physical bullion.
Physical. So we're talking actual bars.
Actual bars and coins. Gold, silver, platinum, or palladium. It is a tangible thing. You could drop it on your foot and it would really hurt.
Okay, I have to stop you right there because I definitely have this image in my head. If I go out and open a gold IRA, do I get to keep the gold? Like, can I hide it under my mattress so I can feel like a pirate?
That is the famous mattress myth. And honestly, it is the absolute quickest way to destroy your retirement savings. The answer is a hard, strict no.
But why? I mean, if it's my asset, I paid for it, why can't I hold it?
Because of this IRS concept called constructive receipt. Okay. The IRS views an IRA as a distinct tax-sheltered entity. It's separate from you. So if you take personal possession of the physical gold, the IRS considers that a distribution.
Oh.
Yeah, it's as if you withdrew the cash early. So you immediately owe regular income taxes on the full value. And if you happen to be under 59.5, they slap you with an extra 10% penalty on top of that.
So definitely no swimming in a vault of gold coins like a cartoon duck.
Definitely not. The strict IRS custody rule states that the metal must be held by a licensed custodian, and it has to be stored in an IRS-approved depository.
So it's locked away.
Right. It's in a vault, it's fully insured, it is legally yours, but you cannot physically touch it.
Honestly, that feels like a pretty significant trade-off. You kind of lose that tactile sense of security that draws people to gold in the first place.
You do. You definitely do. But you gain this massive tax shield in return. And there's actually another layer of strictness here that trips a lot of people up, and that's purity.
Purity? What do you mean?
Well, you can't just throw, your grandmother's old jewelry or some rare historical coins you found at a pawn shop into an IRA.
Really? But gold is gold, isn't it?
Not to the IRS. It has to be considered investment grade. For gold specifically, it must meet a fineness standard of exactly 0.995.
Wow, 0.995. That is incredibly specific.
It is. So things like American Gold Eagles, Canadian Maple Leafs, certain standard bars, those are totally fine. They're in.
Okay.
But if you have something like a South African Krugerrand or maybe an old British sovereign, those are often just not pure enough to meet the IRS standard.
So what happens if you accidentally buy one of those?
If you put the wrong coin in your IRA, the IRS says it counts as a collectible distribution, not an investment. And boom, you trigger immediate taxes and penalties.
Oh man, that is a massive trap for the uninitiated. You think you're just saving for retirement, and you're actually triggering a taxable event.
Exactly. And this is exactly why the custodian's role is so vital. They act as your gatekeeper to make sure you aren't accidentally buying ineligible metal and wrecking your account.
Okay, so we've got the basic definition down. It's physical gold, it's strictly regulated, and it's living far away in a highly secure vault. Now, let's talk about the why.
The big question.
Yeah, why would anyone go through all this trouble paying storage fees and custodian fees? What is the superpower of doing it this way?
The primary superpower is tax-deferred growth. And to really understand why this is a superpower for gold specifically, we kind of have to talk about how gold is taxed outside of an IRA.
Okay, let's do comparison. Let's say I just buy a gold bar online and stick it in my heavy-duty safe at home. What happens when I eventually sell it?
This is the part most people just don't realize. The IRS considers physical gold to be a collectible.
A collectible?
Yeah, it's in the exact same tax category as fine art, vintage wine, or rare stamps.
Wait, really? So it's not treated as capital gains? I just assumed everything investment-related was capital gain.
Well, it is capital gains technically, but it does not get that favorable long-term capital gains rate that stocks get. Stocks are usually capped at 15% or 20%. Collectibles are taxed at a maximum rate of 28%.
Ouch. 28%. So if I make a nice profit, the government just steps in and takes nearly a third of it.
Exactly. That is a massive friction point for investors. Every single time you sell to rebalance your portfolio or simply to take a little profit off the table, you lose a massive chunk of your money to that 28% tax. It just severely slows down your ability to compound your wealth.
Okay, I see the problem. So enter the Gold IRA. How does wrapping it in this account change the math?
Inside a Gold IRA, all of that growth is tax deferred. Let's use a really concrete example straight from Doug Young's research.
Bring it on me.
Let's say your Gold IRA holdings grow by $5,000 in a single year.
Okay, I'm up $5,000. That's a solid year.
In a taxable account, like that safe in your house, you'd be looking at a potential 28% liability hanging over your head the second you decided to sell that gold. But inside the Gold IRA, you pay zero taxes on that gain in the current year.
So that entire $5,000 just stays in the account.
All of it. And this is the real so what moment of the whole strategy. Because you aren't paying taxes annually on those gains, that full $5,000 stays in the pot to generate even more growth the next year.
It's the snowball effect.
Precisely. Over 10, 20, or 30 years, that compounding effect, money making money on money that would have otherwise gone to the IRS, is mathematically incredibly powerful. You are effectively driving your retirement vehicle without the parking brake on.
That's a really great analogy. It's all about velocity. But let me play devil's advocate for a second here.
Sure.
That tax-deferred snowball, that is a future benefit. We live in the now.
Yeah.
And right now, between inflation, gas prices, everything else, cash flow is pretty tight for a lot of people.
Yeah.
Does a Gold IRA actually help me when I sit down to file my tax return this April?
It certainly can if you're looking at a traditional Gold IRA. And this brings us right to our second pillar, deductibility.
I love that word. It basically translates to saving money.
It basically is. The contributions you make to a traditional Gold IRA may be tax deductible, which means it lowers your taxable income for the current year. Doug's research provides a really clear scenario to illustrate how this works.
Walk us through it.
Okay, imagine a high earner. They're making $150,000 a year.
Okay.
That income puts them in a pretty significant tax bracket. Now, suppose they decide to contribute $6,000 to a traditional Gold IRA.
So they just move $6,000 from their checking account over into this gold vault.
Right. And on paper, for the IRS, their taxable income for that year just dropped from $150,000 down to $144,000. They simply aren't taxed on that $6,000 right now.
Man, that is significant. Depending on their exact bracket, that could be a savings of what, over $1,000 in actual cash taxes owed?
Easily. You're essentially funding your own retirement with money you would have otherwise just sent off to the IRS. You're paying yourself instead of paying the government.
Right.
I can hear the but coming.
There is always an asterisk with the IRS. Is it really that incredibly simple? Can literally anyone just dump money in and get a tax deduction?
No, and I'm really glad you asked that. The deductibility is not automatic across the board. It heavily depends on whether you or your spouse are covered by a retirement plan at work, like a standard 401k.
Okay, so what's the catch there?
If you do have a 401k at work and you make over a certain income threshold, that IRA deduction starts to phase out.
I see. So if I have a 401k through my employer, I might not actually get the full upfront tax break on my Gold IRA contribution.
Exactly. Now, you still get the tax-deferred growth, the snowball effect we talked about.
Yeah.
But you might lose out on the immediate tax deduction today. You have to check your modified adjusted gross income against the specific IRS limits for the year.
Got it. So it's always worth a quick 5-minute call to a CPA, just to be sure.
Oh, always.
Good advice. Always read the fine print. Speaking of fine print, let's talk about limits. Because I feel like whenever I get super excited about a tax loophole, the government immediately steps in and says, whoa, not too fast.
They usually do.
Yeah.
Oh.
We can't just dump $1 million into a Gold IRA this year, can we?
No, you definitely cannot do that. The IRS has very strict contribution limits for new money going into these accounts. And since we're looking ahead in this deep dive, let's look at the actual numbers for the year 2026 provided in the bulletin.
Okay, what is the cap for 2026?
For 2026, the standard limit is $7,500 per year.
$7,500. That seems, I don't know, a little low. I mean, if you're trying to build a whole robust retirement portfolio from scratch, that's not going to get you there very fast.
Well, keep in mind that limit is for those under age 50. Once you hit 50 or older, you get what the IRS calls a catch-up contribution. That bumps the annual limit up a bit to $8,600 per year.
Okay, so $8,600 if you're getting a bit closer to retirement age.
Yeah.
But let me clarify something here, because I know people get really confused on this point.
Yeah.
Is that $8,600 just for the Gold IRA? Like, can I put $8,600 into my Gold IRA and then go put another $8,600 into my regular stock market IRA at my bank?
No, and this is the major total bucket warning I always try to give people. That limit, whether it's $7,500 or $8,600, applies to all of your traditional and Roth IRAs combined. It is one single bucket.
Oh, wow. So I really have to choose.
You have to slice the pie. If you max out your Gold IRA with $7,500, you cannot put a single dime into your Vanguard or Fidelity IRA for that tax year. You absolutely cannot double dip.
That is such a crucial distinction. I can easily see someone accidentally triggering a penalty just by thinking they have separate limits for separate accounts.
It happens all the time, unfortunately. And let me tell you, the penalties for excess contributions are a headache you do not want.
How bad is it?
You are taxed 6% per year on the excess amount. For every single year it remains in the account, it just quietly eats your returns alive.
Yikes. Okay, now wait a minute. You mentioned these limits are for new money.
Right.
Most people I know who are getting into gold, they aren't starting from scratch by dripping in $7,000 a year. They have a big old 401k from a previous job, or some IRA they've been ignoring for a decade. Can they move that money over?
Yes, and honestly, that is actually how the vast majority of Gold IRAs are funded. That involves a separate mechanism called a rollover.
Okay, so rollovers bypass that annual limit.
Exactly. The $7,500 limit is strictly for new cash contributions straight from your paycheck or bank account.
Yeah.
But if you have, say, $100,000 sitting in an old 401k, you can roll that entire amount into a Gold IRA without triggering any tax penalties, assuming, of course, you do it correctly.
Okay, that makes a lot more sense. So the contribution limit is for the slow annual drip feed, but the rollover is how you move the big, heavy chunks of wealth.
Exactly. And the direct rollover is the absolute key here. You want the money to go directly from custodian A to custodian B.
Like a wire transfer between the institutions.
Right. You never, ever want the check written out to you personally. If the check comes to you, the IRS immediately starts a 60-day clock. And if you miss the deadline to deposit it into the new IRA,
Let me guess. Taxes and penalties.
huge taxes and penalties.
It sounds like a really stressful game of hot potato. Just don't hold the potato.
Let the professionals handle the potato for sure.
All right, so let's recap where we are. We've put the money in either via a rollover or those annual contributions. We've respected the total bucket limits, and we've just let it sit there and grow tax-deferred, completely avoiding that nasty 28% collectibles tax.
Smooth sailing so far.
But now we fast forward. We are retired. We are finally ready to buy a boat or spoil the grandkids or honestly just buy groceries, given how inflation is going. How do we actually get the money out?
This is the exit strategy. And honestly, this is exactly where the deferred part of tax deferred finally comes home to roost.
Uncle Sam comes knocking.
He kicks the door down. With a traditional Gold IRA, your withdrawals are taxed as ordinary income.
Okay, ordinary income.
That means whatever tax bracket you happen to fall into at the exact time of withdrawal, that is the tax rate you pay on every single dollar you take out.
Oh, wow. So if tax rates skyrocket in the future, across the board,
then you are paying those higher rates on your gold withdrawals. That is the fundamental risk you take with deferral. You are basically betting that your tax rate in retirement will be lower than it is right now.
that feels a little like gambling with policy.
It is a bit, but there are strategies to manage this risk. The source material spends a good amount of time discussing something called bracket management.
Bracket management. That sounds very technical. What does that actually look like in practice for a retiree?
It's essentially about being very strategic with how much money you take out in any single year. Let's say you need $50,000 for a home renovation.
Okay.
If you take all $50,000 out of your Gold IRA at once and you add that to your Social Security, plus whatever other income you have, you might accidentally push yourself up into a higher tax bracket.
Oh, I see.
Suddenly, instead of paying 24% on that money, you're paying 32%.
So you're accidentally punishing yourself just for taking your own money out.
Exactly. So the smarter play is to spread those withdrawals out. You take out just enough in December to fill up your current lower tax bracket, and then you just wait a few weeks until January 1st to take the next chunk. You smooth out the income over 2 tax years to keep your overall rate as low as possible.
That makes a ton of sense. It's all about pacing yourself. But here's a scenario that genuinely worries me about all this.
What's that?
What if I don't want to take the money out at all? What if the gold market is in a temporary dip, or I just don't need the cash and I want to leave it all for my kids?
Well, if you have a traditional Gold IRA, the government will eventually force your hand. These are called RMDs, required minimum distributions.
The dreaded RMDs. When do those actually kick in?
Under the current rules, starting at age 73, you must start taking a specific amount of money out every year, whether you actually need it or not. The IRS has waited long enough and they want their tax revenue.
So you're forced to withdraw.
Yes, and this creates a really unique problem for physical gold owners. It's called the liquidity trap.
Explain that. How is it different from a stock IRA?
Well, imagine your RMD calculation for the year says you need to withdraw exactly $12,000 based on the total value of your account.
Okay, $12,000.
But your Gold IRA only holds solid 1-ounce gold bars. You can't exactly take a hacksaw, saw off a little corner of a gold bar, and sell just enough to hit that specific dollar amount.
Right. It's not perfectly divisible. You can't break a gold bar like you break a $20 bill at a convenience store.
Precisely. So to satisfy that $12,000 requirement, you might be forced to tell your custodian to sell a whole bar or 2 whole bars, perhaps right when the spot price of gold is having a bad month.
Oh, man. So you lose the asset just to pay the tax.
Exactly. It's highly inefficient.
That sounds incredibly frustrating. Is there any way around that forced sale? Can I just tell the custodian, hey, I'll take the gold itself as my distribution?
You actually can do that. That is called an in-kind distribution. You simply tell the custodian, please don't sell the bar on the open market. Just physically ship it via insured mail to my house.
Oh, nice. So I finally get the gold in my hands.
You finally get the gold in your hands, but, and this is a massive but, the IRS still treats the market value of that gold bar as ordinary income for that year.
Wait.
Yep. So if the custodian ships you a gold bar worth $2,500, you now owe regular income taxes on $2,500 of income.
So I get a heavy metal bar in the mail, but I also get a tax bill in the mail.
Yes, you do. And here is the kicker. You need to have the liquid cash sitting in your personal checking account to actually pay that tax bill to the IRS. You obviously can't pay the IRS by mailing them back the gold bar you just received.
Wow. Okay, that is a massive pro tip right there. Do not just assume you can take physical delivery of the gold and dodge the tax man. You have to have the actual cash on hand to afford the taxes on your own gold distribution.
Exactly. It catches a lot of people off guard. Now, this whole conversation brings up the big alternative, though. Up to now, we've only been talking about traditional gold IRAs. What about the Roth?
Ah, yes, the Roth IRA. Kind of the darling of the personal finance world right now. How does that work when you throw physical gold into the mix?
The Roth is the exact inverse of the traditional. With a Roth, you pay the taxes now, up front, before the money ever goes into the account. You're contributing post-tax dollars.
Okay, so it hurts a little more today.
It does. But then the magic happens. It grows completely tax-free inside the vault. And when you eventually take it out in retirement, every single penny, gains included, is 100% tax-free.
That is incredible. What about those dreaded RMDs we just talked about?
That's the absolute best part.
Right.
Roth IRAs have no required minimum distributions during the original owner's lifetime.
None.
Zero.
So if you have a Roth Gold IRA, you can literally just let that gold sit there in the vault, quietly compounding forever.
Potentially forever. You never have to sell a single ounce or worry about the liquidity trap if you don't want to. It is a wildly powerful estate planning tool, too, because you can eventually pass that untouched gold vault down to your heirs, and they inherit that amazing tax-free status.
That is huge.
It is, but you have to be willing to bite the bullet and pay the taxes up front today.
It's like the ultimate financial marshmallow test. Do you eat the marshmallow right now, taking the immediate tax deduction today with the traditional, or do you wait patiently for 2 marshmallows later, getting that completely tax-free growth and no RMDs with the Roth?
That is perfectly put. It completely depends on comparing your current tax bracket against what you think your bracket will be 20 years from now in retirement.
Which brings us nicely back to the central comparison of this whole deep dive. We spent a lot of time talking about the IRA structures and the tax code, but let's zoom out to the asset itself for a minute.
Sure.
Why go through all this incredible red tape? The custodians, the purity rules, the RMDs. Why not just go buy a gold coin and put it in a safe in the floorboards?
Let's do the final showdown. Physical gold held at home versus the gold IRA.
Okay, ring the bell in one corner. Physical gold hidden at home.
With physical gold at home, you have total, absolute control. If the power grid goes down, if the bank's inexplicably close, if there is an actual zombie apocalypse, you have the shiny metal right there in your hand to barter with.
It's the ultimate tangible security blanket.
Right. But you also have all the physical security risks, theft, losing it, a house fire, and financially speaking, you have absolutely zero tax shelter. Whenever you eventually sell it, you are going to pay that nasty 28% collectibles tax on every single dime of profit.
Ouch. And in the other corner, the gold IRA.
In that corner, you give up your immediate physical access. You have a custodian managing things. You have annual storage fees. You cannot touch the metal until you are 59 and a half without triggering a penalty.
A lot of restrictions.
Yes, but you gain the United States tax code as a powerful ally. You get the potential for immediate tax deductions today. And you get that beautiful tax-deferred compounding that can significantly accelerate your wealth accumulation over a 20 or 30-year timeline.
So it really sounds like it comes down to what specific problem you're trying to solve.
How do you mean?
Well, if you're solving for total societal collapse, maybe you really do want the coins hidden in your house. But if you're solving for, I just want a very wealthy, comfortable retirement, the math on the IRA structure is honestly just hard to beat.
That is the key takeaway right there. A gold IRA isn't just about hoarding shiny metal in the dark. It's a very specific financial planning tool. It's about preserving your purchasing power over decades in a highly tax-efficient way.
What really stands out to me after going through all this is how it just completely shifts the narrative. We usually think of gold as this ancient, almost primitive form of money. And we think of taxes as this super modern bureaucratic nightmare. But when you combine them properly, you actually get a very sophisticated financial instrument.
It is incredibly sophisticated, and it absolutely requires diligence. You have to watch those contribution limits like a hawk. You have to actively plan for your RMDs. You really need to understand the critical difference between a direct and an indirect rollover.
Right.
But if you navigate all of that correctly, it effectively allows you to legally opt out of the inflation and taxation cycle that quietly eats away at so many standard retirement plans.
Wow. So here is the provocative thought I want to leave you, our listener, with today. We talked a lot about the traditional versus the Roth structure. The traditional IRA basically bets that your taxes are going to be lower in retirement. The Roth bets that paying the taxes right now is the better deal.
Right. You're basically placing a bet on future government policy.
Exactly. So I want you to look at the national debt. Look at current government spending. Do you genuinely, deep down, believe that tax rates will be lower in 20 years? Or does paying the tax man today, locking in the current rates, and just never having to speak to him again regarding that gold, does it sound a little more appealing?
That is the multi-million-dollar question. And honestly, there is no single universally right answer. There's only the answer that lets you sleep peacefully at night.
Exactly. And hey, if you want to dive deeper into the real nitty-gritty of these individual companies, because remember, who you actually choose to be your custodian matters a whole lot. You really need to check out the source material for our deep dive today.
Yes, for the highly detailed breakdowns, the fee schedules, and the comparison of the top-rated companies for 2026, you should definitely go read the full Gold IRA Companies Bulletin. You can find all of that research over at goldiracomepaniescompared.com.
So that's goldiracompaniescompared.com. Go over there, do your own homework, and please don't just take our word for it.
Because knowledge is only power if you actually apply it.
Well said. Thanks so much for breaking all this down with me today. It is always surprisingly fun to find the shiny, hidden parts of the tax code.
Always a pleasure to be here.
And to you listening, stay curious, keep asking the hard questions, and we'll see you on the next deep dive.